everyone. Welcome to another episode of the Steady Wealth Podcast. What we're going to talk about today, as we have just a few weeks left of runway in 2023, is what are the portfolio consequences if interest rates were to stay notably higher, more or less maybe the levels we're at right now, or just a 4.5% to 5% yield range in the U.S. Treasury market. What does that mean from a portfolio perspective and also from a trading perspective? Let me kind of preface this all by saying that there's lots of arguments out there that I hear that this higher interest rate field is because rates are so high now, it's going to destroy everything. As far the way we're looking at it is not so much the fact that rates are notably higher now than they were 2 years ago. It has a lot more to do, maybe everything to do with the rate of change. I think there's a bit of a misunderstanding among at least some people that I come across on broader financial media. In fact, if you go back far enough and you look at U.S. rates over a longer period of time, the 4 to 5% range tends to be more of the norm than the exception. So it's not the absolute level of rates, it's the fact that we've come from an extended period of ultra low rates to now a more normalized range, and that ultimately is going to have far-ranging consequences across asset classes. Let's start off, and I'm going to share the screen here for those people on YouTube. For those people watching us in traditional podcasts, do not worry, you're not missing a thing here. I'm just going to reference a couple of things here, and I think that would be something noteworthy, both in terms of visual aid here on YouTube, but also in terms of what I'm going to talk about. So when I describe these charts. So let's first talk about the trading aspect of it all. What do higher rates have to do, if anything, with the more near-term stuff? I know a lot of you folks out there are, to some extent at least, consider yourself self-directed traders, which of course makes a lot of sense, because having someone trading your account and having input, that is more difficult than having an investing relationship with someone. So let me share with you the basic thought here. So we're just looking at the S&P 500. Now, higher interest rates, by and large, are going to mean that risk assets in general will be having applied a higher discount rate. I've been saying this pretty much all year, and I think the year before, so in 22, and now here in 23, and we're almost done with 23. Higher rates are going to mean lower returns for the most part for equities. Now, notice I'm saying for the most part, not for every single stock. There's going to be some stocks that do very well, but they will be more of the exception than the rule. And again, that has to do with basic discount DCF modeling. If you ever look at a discounted cash flow model, if you have a higher multiplier, you have lower net present value of that. So we think, just broadly speaking, we're going to see lower returns in the equity market. And the equity market, whether we look at the S&P 500 or something else, has indeed now for the past 2 years really just gone sideways. So that is factual. That's not me making this up. In the September, in fact, let's see, if we go back to November 2021, we were more or less at the same levels we are right now. In fact, in early December of 2 years ago, we were literally where we are right now. Equities have done nothing. And we think that's going to remain the case. I don't think it's going to be a massive breakout in equities. Again, in a few names, that's possible, but that's going to be more the exception. The rule, and good luck finding those names, by the way, is more the point. Now, before we continue talking about that and different asset classes, let's talk more about from a trading perspective. So from a trading perspective, typically what we'll tend to see when rates are at a higher regime like this, and again, particularly when the rate of change has been so markedly, mean reversion strategies will tend to do better. What does that mean? That means using something as simple, and this is an overly simplistic tool, but like oscillators. There's different tools out there from MACD, and we have a lot of proprietary stuff that's fantastic, and that combines a whole bunch of things together, which I think is the best thing, better than sliced bread. But even from a very simplistic perspective, and I do caution they are overly simplistic, but using like a MACD or a stochastic thing where we get measurements of whether a stock or an ETF or another asset class is extremely overbought or oversold, they can be very useful. They are less useful when you have very strongly trending markets. So I'm describing here a chart from, let's say, the year 2016 on to 2020. And for those people that are seeing this chart, you can probably see it. I'm going to quickly describe it here for everyone else as well. But basically, what we'll tend to see is a lot less mean reversion and basically less volatility in markets that are strongly trending. Let me quickly bring this up again. If we look at a low interest rate regime, again, for example, we had in 2010, 2012 into basically the top in 2021. Yes, there were some shocks like COVID, but that lasted a few months, a couple other things along the way. But for the most part, it was not a great time to be trading for mean reversion. It was better to stay long. When you go into a markedly higher interest rate environment from a trading perspective, and a lot of this is more, it's both the mechanical aspect of it, but also the psychology. I see a lot of people still basically all they have is breakout strategies. And guess what? They stopped working 2 years ago. They're still working on a couple of stocks, but it's about it. And I say a couple, it's obviously a handful. But for the most part, mean reversion works better. So mean reversion strategy, so basically meaning shorting something or selling something once you have a sharp rally, and then maybe buying again once it has a sharp sell-off, is on average a better strategy when rates are in absolute terms much higher than they were for, in this case, the past decade or so. So from a trading perspective, I think this is also very much going to be the case as we head in 2024. I see a continuation of that playing out where, again, it's not so much just being long assets or equities. It's really about playing the mean reversion, right? So it's a higher probability to sell or short into extreme rallies and a higher probability as well to buy into sharp sell-offs for trades. Because ultimately, and it's very simple, because ultimately things go sideways. Again, the S&P 500 for the past 2 years has literally just gone sideways. So I think that's an important thing. And a lot of people that are long assets did okay this year, particularly long equities, long S&P basically, right? The equal weighted stuff didn't do anything. But the regular S&P, and it's masked the fact that they've not done well with chasing their chart breakout strategies, which by and large, again, except for a few dozen stocks or something like that, have really stopped working. Overall, doesn't mean there couldn't have been a good trade here or along the way, but I think that's an important message I'd like to pass along. Other stuff, I think bond prices typically fall. So now we're talking about equities, talk about bonds. Bond prices tend to have a more difficult time in the initial stage of equities basically going sideways because rates have had a shockingly higher move. So I'm going to bring up the chart here of just the treasury yield so people can get their head around this, or just treasury prices. So the 2-year or even the 10-year, let's look at the 10-year bonds, and I'm going to describe this here. Doesn't look as terrible on the chart here, but 10-year bond prices haven't really done anything. In fact, if you look at this through the lens of an ETF, like the TLT ETF, might be a bit more apt to make sense of this. What we're seeing or showing here is a strong decline in the absolute price of bonds. However, once rates begin to stabilize, and this is really the forward-looking message here heading into 24, the bond market becomes increasingly attractive. Not necessarily because one would expect a massive rally in bond prices. Remember, this podcast here is about what happens if rates remain elevated. Then the bond market may just go sideways, but remember, it's going to yield a lot more. So let's take a treasury note around 2 to 5 years. If that yields us 5%, that's pretty darn good on an annual basis. We want to keep that in mind. I think that's extremely attractive as an alternative to equities, or certainly because we have to be less picky about which part of the bond market we choose, as long as we stay within investment grade. Let's not go too much into non-investment grade. That's another ball game. But I think the bond market has to be looked at through the lens of income and not so much directional movement. I way early thought that back in 22, or in the heading into the summer, late spring, summer 22, that we would see a mean reversion in bonds. We didn't, meaning bond prices continued to go down and bond yields continue to go up, I still think we'll see mean reversion in that. I think bond yields will come down, but again, the point of this podcast is to imagine what happens to bonds if the bond levels, if the yield levels remain somewhat high. So that might just mean more than 3%, right? It would be opportunistic to be a buyer of bonds here, and I'm talking more about the treasury market and basically US investment grade, European investment grade as well, I would throw in there. Makes it very attractive, not only from a potential price appreciation if rates come down, but again, just the absolute price level. So that's what happens to bonds. In the equity market, this is really important, just going back to stocks now, high dividend stocks. I have come across way more portfolios this year when I talk to prospects for our investment advisory firm, Blue Marlin Advisors, that are completely chock full of high dividend paying stocks. High dividend stocks face pressure as fixed income alternatives become more appealing. And so not only have we now had a shock to interest rates, so rates go a lot higher, so high dividend stocks have basically, they haven't gotten totally decimated, but they've become a much less attractive. And I think that's going to continue to be the case. This is not a case against dividend paying stocks. It's just saying, hey, there's now an alternative out there. So basically an alternative that's essentially risk-free, let's call it the 3-month US Treasury note being risk-free, that alternative is becoming hell of a lot more attractive versus dividend stocks, just because there's less risk, at least the way the financial system looks at it. Particularly growth stocks as well that are interest rate sensitive may experience higher volatility as well. So you think about that, if rates remain at levels that are quite elevated, at least elevated looking back 10 years, then there might be a heightened sense of volatility that we have to deal with once people come to that realization. I still think the rate market right now is pricing in about 4 cuts. And I do think actually there will be some cuts, but it'll still come with more volatility. Real estate, that's really depends on what kind of real estate we're talking about. Every real estate market is a bit different, but I'll quickly share with you just a chart for perspective of the XLRE. This is an ETF that represents the S&P 500 real estate sector. It's peak to trough as I'm recording this here in the latter part of November 23. It's down about 30%. We had a drop as much as almost 40%. And again, that makes sense because alternatives to real estate. So there's, again, multiple ways of looking at this. Alternatives to real estate are becoming more attractive. We have higher interest rates. Again, think about the risk-free rate, what that means. If I can make 5.5% risk-free, maybe throw some option strategies around that, or go a bit further on the risk curve in the fixed income market. Why would I have to buy real estate that looks shakier and shakier because of the higher rates, where they have to refinance at some point, when I can get, if I'm a little bit creative, make 7, 8, 9% with very little risk because rates are so high. So real estate too, again, depending on the sector, this is not an all-encompassing real estate. I think there's a lot of interesting thing in real estate, but think about that. And it's all because the overarching message that I'm bringing across here, or I'm hoping to bring across, is if rates remain somewhat elevated, call it in the 4 to 5% range for an extended period of time, people with every month that goes by will start to think more and more about, and still people are still waking up to that, by the way, still. What does that mean? How much more attractive is this risk-free rate, or nearly risk-free, versus the risk I'm taking somewhere else? Especially if inflation comes down as it has, and it may resurface at some point. But right now we've got a positive carry on a lot of these trades, meaning if I make 5% on a treasury note and I have 3% inflation, that is a positive carry of 2%, meaning a 2% real positive interest that I'm collecting. Commodities are more challenging, and I want to be careful in going too deep down this rabbit hole. But let's think about gold, for example. Gold will tend to do okay if real interest rates become more negative. And I think that is likely, or less positive. That's likely going to be the case. However, we could also see gold be something that it takes time for this thing to kick in. But in the meantime, as people wake up to the fact that gold, which doesn't pay a dividend, is less attractive than getting risk-free yield at 5%, there could be some give and take that people will evaluate gold as, okay, on the one hand, it may have upside potential. On the other hand, I can take money that's sitting in gold that's not yielding me anything, because gold is a lump of metal, right? Doesn't give you a return, no dividend, I should say. What if I take some of that money and put it into bonds? Again, I do actually think gold will be okay here. There's a bunch of other dynamics here, but that's something to keep in mind as well. And that kind of gets us into cash. Now, cash and in general, cash equivalent assets are probably the ones that are benefiting more here. So there's a saying that's been out there for a while: cash is trash. Cash has become king again in many ways. If you think about cash and short-term instruments can really benefit from short interest rates rising because they offer higher yields, as I just said, without the price volatility of long-term securities. So if I were to sum up everything I just said, it's about the de-risking one can do now given where rates are. So as we head into 24, if I were to summarize this, I think there's going to be still very little upside in equities, which has been our base case for the past 2.5 years. Has it factually occurred for 2.5 years? I think the bond market will begin to stabilize, but unless there's a real interest rate cuts, obviously we'll have not as much upside, but still very attractive because of the higher yields. Cash really is probably where it's at to some extent. I think there's always pockets of risk taking. And then last but not least, let's think about what this means, just going back to where I was before on more on the trading side. Think about what this means from a trading perspective. Again, I think a lot of people are still in this mode of basically chart chasing. I would really encourage people to stop the chart chasing and think more about mean reversion strategies for really, at this point, I'm going to say for 2024, just I think that was the case for 2023. There's very few stocks that really did great. Most of them have basically just been really good mean reversion trades. So think about this like putting a big collar, or if you're an options person, putting an iron condor on the S&P 500 would have probably been a hell of a strategy this year in 2023. So I think something similar could be the case with 2024. So hope this helps, folks. Have a great rest of your day whenever you are, and have a great holiday season as well.